This is Matt Tews with Home Loan Base Camp, your provider of mortgage everything. When it comes to information, we're going to set you up. Matt, what the heck are tax and insurance impound accounts? Well, I'm going to answer that question for you. We have a couple options when we've got a certain amount of equity position in a home, whether you're purchasing or refinancing. So typically, if you have less than 20% equity in your home, sometimes 10% is the marker, the servicer or loan servicer is going to request that you have tax and insurance impound accounts. Now, regardless, if you have 50% equity and you have a loan, you can make the choice to have the servicer do your taxes and insurance impound accounts for you. So basically, the servicer is going to make the payments for taxes and insurance in your name, on your behalf. But in order for them to do that, they need to have some money, right? So let's say you're buying a house and you're purchasing in June. Your first payment for that home is August 1st. Up front, when you're buying the home, through the loan process, we're going to end up making sure you've got 12 months of insurance already done. So as of August 1st, actually as of June 1st, you're going to have a full year of insurance set. But there's going to be another payment in 12 months that's going to be due. So the loan servicer is going to start taking 1/12 of whatever that policy amount is from you in your mortgage payment. So they're going to set that 1/12 of insurance aside in this account. Now, also have taxes as well for the county. So whatever the tax amount is going to be, 1/12 of the year's worth is going to be taken in your mortgage payment as well. So that's set aside in this tax and insurance impound account. Now, the taxes are going to be due 2 times per year. Around here, it's going to be November and February. So if you're purchasing a home and in August is your first mortgage payment, so the first time the servicer is going to take some money from you to put in the account, when November comes around, there won't be enough money to actually make the payments. So the servicer up front when you buy the house, through closing, is going to ask for some reserve money, some additional funds that they're going to stick into this account. So they know when they need to make these 2 future payments in November and February to the county, there's going to be enough money there. So that's pretty much it. It's either you get to make your payments and manage your taxes and insurance yourself, or the loan servicer will do it for you. And they're going to do it by taking 1/12 of whatever is going to be due for insurance and taxes in your mortgage payment. Now, there's one more piece when it comes to taxes. When you buy a home, the taxes that are going to be received and paid for through the county is going to have 2 tax bills, and those tax bills are going to be associated with the previous owner. So depending on what your home is worth when you buy it, whether it's more than the previous owner paid or less than the previous owner paid, the county is going to look into what your actual tax basis is going to be for that property, and they may reassess things. So when your property is reassessed for its true current value, they're either going to ask for some additional money from you in a reassessment, or they may actually give you some money back. So it depends on what the climate is and how things have gone versus the previous owner. Tax and insurance impound accounts, not too difficult.